Okay, let's jump right in. There is exactly one power sector company with deep roots in West Bengal coming to the IPO market right now. And believe me, no serious institution wants to miss it. We all know what peak execution in this space looks like, right? Just look at Apar Industries. They ran their conductor lines at 95% utilization and created absolute generational wealth for their early investors. But that early compounding story, it's already well understood, and frankly, it's largely priced in. Today, the search for the next Apar lands squarely on a 742 crore rupee issue. We're going to find out if laser power and infra is that next massive growth engine, or if we're looking at a brilliantly disguised value trap.
Okay, let's dive into this. 30,000 crore rupees. That is the staggering size of the new power capex wave currently sweeping outward across West Bengal. We're talking about a regional infrastructure boom of historic proportions here. But here's the catch. About winning these massive state tenders, it actually takes a lot more than just manufacturing the cables. You need to physically make the cable, sure, but you also have to have the capability to execute the engineering, procurement, and construction, the entire EPC side of things. And at this kind of massive scale, there are really only two major players pulling off both.
And this is exactly where the setup gets fascinating. Of those two major players, Luminoy Industries has decided they want to stay private. So that leaves laser power and infra as the sole exclusive public avenue for any investor or institution looking to target this specific highly lucrative regional setup. It's essentially a monopoly on public market access to the specific wave of capital. But hey, before we crown them the undeniable winners, we have to take a really hard look under the hood at how effectively they are actually running their operations.
Now, what's really interesting about this data is the stark 24 percentage point utilization gap. You have Apar running red hot at 90 to 95%, but laser power, they are sitting at just 61.59%. Over the last 3 years, Laser aggressively expanded their manufacturing capacity by 38%, scaling up to more than 85,000 metric tons across their 3 plants. But the production simply did not keep pace with that build-out. Their utilization fell from roughly 86% down to that 62% mark. So, in simple terms, they built the factory way faster than the demand arrived. They are sitting on a massive chunk of idle capacity.
Now, you might hear idle capacity and instantly think the thesis is dead on arrival. But actually scratch that. It's not a death sentence, and here is exactly why. The EPC multiplier. When a company is backward integrated like Laser, their EPC arm isn't just some separate business division. It acts like a compounding financial multiplier, basically a secret weapon for their manufacturing lines. Because they make the cables and they build the substations, their internal ecosystem completely changes the core economics of every single bid they enter.
Let's break down how this integration captures a highly lucrative dual margin. On one side, you have the product margin from actually manufacturing the cable. On the other side, the contractor margin from executing the final project. Because Laser controls its own input costs, literally straight from the wire rod down to the finished conductor, they get to stack these profit chips right on top of each other. This dual margin capture makes them incredibly aggressive on L1 bidding. It allows them to systematically underprice pure contractors who are forced to buy their materials from third parties.
To see just how powerful this captive ecosystem really is, trace this figure, 354.39 crore rupees. That was Laser's internal cable consumption just last year alone. Think about that. Every single EPC contract Laser wins automatically creates a captive sink for their own manufacturing volume. Their construction arm is essentially a guaranteed massive customer for their manufacturing arm. This brilliant feedback loop helps them absorb all those fixed factory costs without needing to spend a single rupee of fresh capital on new marketing or distribution.
And honestly, they are going to need all the capacity they can get because of the post-2026 runway. The 2026 election cycle fundamentally changed the economic direction of the state, easing what had been a long phase of industrial hesitation. We are now seeing a massive, much stronger flow of central and state project money unlocking across the board. Just look at the sheer scale here. An 18,000 crore rupee budget to upgrade power distribution, a nearly 68,000 crore railway decongestion program, and a smart border project aiming to electrify 600 kilometers. Laser is sitting right in the dead center of this historic capex cycle.
On top of those massive macro tailwinds, they also have a very real technical advantage. Laser holds an exclusive regional license for American TS conductor technology. We are talking about highly advanced, carbon core lines that can carry 3 times the current of traditional lines, all while cutting the line loss entirely in half. That's a huge deal. It's a premium product mix, and it is the exact reason Laser has been able to push its EBITDA margins to nearly 13%. The product is superior, the market is flush with cash, and the factory is already built.
Let's move to and see how this builds into the other side of the story, the potential value trap. Last year, Laser's revenue actually fell by 9.5%. Management came right out and blamed this drop on an industry-wide raw material shortage. But wait, when you compare them to a peer company like Dynamic Cables, who faced the exact same copper and aluminum markets, Dynamic grew their revenue by 17%. So the shortage wasn't industry-wide at all, was it? The problem was entirely internal.
The real culprit behind that drop, 138 days. Laser's net working capital days jumped alarmingly from 101 days to 138 days. In plain, analytical terms, the company simply did not have enough balance sheet strength to stock raw materials the way their stronger peers could. Yes, vertical integration and running a massive EPC division definitely lowers your cost, but it is highly capital intensive. This working capital blowout completely exposes the immense pressure building up on their balance sheet.
So the crucial point is understanding what this IPO is actually funding. Out of the massive 542 crore rupee fresh issue, 490 crore is not going toward growth. It's not going to new factories or market expansion. It is going straight to debt repayment. This entire IPO is fundamentally just a balance sheet reset. They are raising public money simply so the company can finally afford to buy the inventory it desperately needs to execute the work they've already won.
Which naturally brings us to their massive 3,200 crore rupee order book. Now, on paper, it looks absolutely phenomenal. But as a focused learner evaluating this space, you have to remember that a backlog is completely theoretical until a company can afford the raw materials to build it. An order book provides visibility for sure, but it does not guarantee revenue. Until they repair the balance sheet and get that working capital fully under control, all those secured contracts are literally just numbers on a page waiting for copper and aluminum to arrive.
And this brilliantly illustrates exactly what we need to monitor post-listing. Remember, we aren't here to make a buy or sell call. We are here to analyze the mechanics of the business. This is your strict watch list matrix. Number 1, watch for net working capital days to drop back below 101. Number 2, that 61% utilization must climb back above 80% by FY28. Number 3, keep a very close eye on March 2027 to ensure the premium TS conductor license is actually renewed. And most importantly, number 4, absolutely zero new greenfield capex until the existing 85,000 tons of capacity is fully loaded.
Laser power is not Apar today. It is essentially a massive execution option. The demand undeniably exists, the political and economic roadblocks are clearly easing, and the hard assets, the factories themselves, are already firmly in place. If they can close that utilization gap, the operating leverage they'll experience could be absolutely incredible. But if they can't manage their working capital, all that state-of-the-art capacity just stays stranded. One massive CapEx wave, two very different futures. The factory's built, so the only question left for you to ponder is, can they finally flip the switch?
If you like our video, please like, share, and subscribe.